What is up, guys?
What is going on, people?
Happy Super Bowl Sunday.
Yes.
All you football fans out there.
Thank you in advance for all of you people who are joining us. We know that there is a very important thing going on at the moment.
We'll make sure it's 30 minutes for you guys. It'll be good.
Yeah, we have Pirasaanth actually joining us today. He's going to be adding a bunch of tax advice. Oh yeah, look at all these guys. What's going on, guys? Thanks for joining. What's going on, Rob? Right on. Oh yeah.
We tried to squeeze into a regular frame for you guys on Instagram.
Yeah, we decided, we had a bunch of people, we had probably like 50, 60 people reach out yesterday about the flip product. You know, we posted it again because we had a lot of great feedback. So we're just going to wait till everybody comes on here. What's going on, Matt? What's going on, guys? We're going to just go over that flip product really quick. And we actually have that special guest, Pirasaanth. He's going to be coming on. He is one of the owners of Galleon. He owns a CPA company. I use Pirasaanth, and I send him all my clients. He is probably one of the most knowledgeable CPAs that I personally know. I trust him with a lot of my clients. So I guess what we're going to do today is just waiting till everybody gets on here. What's going on, everybody? Hey, hey, hey. Right on. All right, what's going on? Perfect. So just touching a little bit on our 20,000 down product before we get into the nitty-gritty details. If anybody missed it about a month ago, the 20,000 down product, we've seen a ton of great results for our clients. It essentially is like 20,000 down.
Yeah.
There's no ifs, ands, or buts. Like, there's no like hidden fees. There's none of that. Like, it's very straight up to the point. What's going on, Steve? Thanks for joining. We are going to see if we can get Pirasaanth on here. Pirasaanth, can you just request to join, man? What's going on? See if we can figure this out really quick. There we go. There we go.
Hey, gentlemen, how are you guys?
Good, my man. How are you?
Doing well, doing well. Thanks for having me on.
Of course. Good. Thanks for coming on.
Thanks for coming on, man. Always great to have new guests. A lot of our viewers really enjoy the expertise that we bring onto our show. So, when I think of CPA, I obviously think of you guys, and we get questions all the time about structuring flip products or how to do it through a tax advantage way. And we thought, what a better way to do it than to get somebody who's truly a professional on it right away. So we got about 30 people on here right now, all looking for a little bit of advice on how to do this. So we're just going to touch base. Why don't you tell everybody about yourself really quickly, and then we'll go through the product, and we'll just go through maybe some questions that people have.
Yeah, for sure, man. So I'm a chartered professional accountant / chartered accountant. Me and my partner own a CPA firm specialized in working with real estate investors. So all the little intricacy areas of real estate we're very familiar with, whether you're buying and holding multifamily residential buildings, whether you're flipping, whether you're wholesaling, whether you're a mortgage investment corporation, a private lender. We've seen it all, and we've worked with clients in that space. The other nice thing is my partner and I are also real estate investors. We currently have a portfolio of over 100 units, continuing to grow very rapidly. So we're very familiar when advising our clients, not only on what the tax implications are going to be, but also from an operational perspective. This year you may be looking to make an acquisition. It makes sense to pay a little bit more taxes and have your financing work out instead of, only looking at the bottom net tax impact. So bringing that operational sense as well as that tax view as well when deciding and making decisions.
Yeah, I think from our standpoint, we just talked about this right before we went live here, but as the mortgage agents, we get, 33% of our questions are mortgage related. The other 33% are, some sort of accounting question, and the other 33% are, legal questions. So we got to be able to refer to you guys to, give our clients the advice. And we've worked with you guys on some real estate deals before, and we've done a lot of, I know Josh started to send a lot of referrals over your guys' way as well too. And, it's having those industry partners that we trust are, it's crucial for us and crucial for our clients as well too. So we appreciate all the help that you guys are able to give our clients.
Yeah, for sure, man. And like you said, I think that relationship's important, and also having those key contacts on your power team that you work very closely with. They understand your goals, where your vision is, and where you plan to take your portfolio. And as long as everybody's on the same team and communicating well together, it's just a well-oiled machine.
And that's what it's all about, man. Just making sure your power team, or make sure the people you work with know what they're doing and are in communication
Yeah.
with each other. Because if one person knows what they're doing, but the other parts don't, then that can be a kind of a break in the chain, and your transaction isn't going to go as smoothly as it probably should.
Yeah, yeah. Couldn't agree more, man.
Yeah, it's when one part of the pie is creative and financing needs to be creative sometimes, you need to have partners who understand how the creative aspects works from all angles. And I know we've had some issues with legal advisors in the past where maybe they aren't fully in the real estate industry and they don't understand creative financing and some of the things that require to be done. And it's the same as the accounting side as well too. Sometimes it requires someone who understands the creativity of it and how that's going to implement taxes and carryover and losses moving forward, and just what the repercussions are going to be and what the benefits are going to be, because it's never a perfect world, right? You can't. I think one of the things everybody is slowly starting to learn is you don't get to have your cake and eat it too, right?
Right.
You can have the advantages from one aspect, but you're going to have some disadvantages from the other aspect. And that's where you come in on the taxing side is, hey, yeah, you're going to get this, this, and this, but, be careful of this because this is going to be the repercussion of it.
Right.
And that's important for people to really understand is the benefits, but what are the things you're going to take some losses in, or what are some of the things that are, could be considered a con to those investors? And those are also just as important to know as it is the benefits of certain transactions.
Yeah, for sure, Aaron. And then the other thing I'd add on to that is sometimes I get a lot of clients reaching out where, they're pursuing a lucrative deal that can potentially net them a lot of money. But right away, one of the first objection points is, oh, I'm going to have to pay a lot of tax on this. Or, tax is often something that stops them from moving forward on the deal. And, I've seen it a lot of times where if you actually do the math, yes, you do have to pay taxes and it sucks, but you're making so much more money on the other end than the amount of taxes that you're going to have to pay. So why is the taxes stopping you from executing that deal and seeing it through? So sometimes it's just a shift in mindset. And, I guess people try not to pay. They don't like paying more tax than they have to.
100%.
I agree. Good catch. No, you have to pay the tax, man. But I mean, if you do it smart and you guys are all on the same page, then there's definitely ways to be able to do it with a tax advantage kind of mindset. So
yeah.
One of the products that we have been using for our clients is the 20,000 down products. We have about 35 people on here right now who are all interested in it. Essentially what this is, it is specifically made for flips, but can also be made for the BRRRR strategy. The maximum purchase price for this product is $800,000. Anything $800,000 and down, you can purchase. You quite literally need $20,000 down. So we look at a handful of things when we're analyzing a deal first. The first is going to be we need an ARV value. So let us know what that after repair value is going to be. Now, obviously, we need you to think about it. We need you to analyze it, think about it. Let us truly don't just give us a random number because it's not going to work. We need a quote. So whether that's you or whether that's a professional, if you've been doing it long enough and you understand how it works, give us a quote based off of your expertise, and we'll be able to use it. We've seen enough quotes now, or our partners have seen enough quotes that we understand. If you're giving us like $1 per square foot, we understand it's not going to work. So let us know what the actual cost of it's going to be, and then we need some comparables on the area that you've been purchasing, the type of property, on market, off market, and sold in the last 365 days. Our partners will then take a look at all three pieces of documentation, verify if the ARV is actually viable, and then from there, it's on our job to ensure that you can actually do the project.
Yeah, something I kind of wanted to ask you, is there any differences from tax standpoints in terms of flipping? Some things that our investors might want to consider, whether they're doing the flip in their personal name, whether they're doing that flip in a holding company, receiving the profits in, carrying over maybe losses, stuff like that. Anything that they could kind of take away from advice from your side that would be specific to the flips?
Yeah, for sure, guys. And then I'll start off by saying the main point that I want investors and flippers to be cautionary about is, so a lot of people are under the impression that when you're flipping, you purchase your property, you put your renovations into it, and then you ultimately sell it at your new ARV price or whatever your fair market value is. A lot of people are under the impression that that gain is going to be considered a capital gain, and you're only going to have to pay tax on 50% of that total gain. However, that's true if you're buying and holding properties. You purchase it, you hold it a while, you rent it out, you ultimately sell a property. That is true. You're going to have to pay capital gains tax on 50% of your total gain. Flipping, on the other hand, is considered an active income business. So when you're flipping and you have a track record of you've been constantly flipping properties, the CRA is going to say this is an active business, and the income you make is going to be 100% taxable on the entire gain. So if you made 100K flipping and you did it in your personal name, you just added a full 100K to your personal income, and depending on how much employment income you have or what your other employment sources are, that 100K could have caused you to jump into a higher bracket or even the highest bracket, and now you're kicking away 53 cents on the dollar to the CRA. Whereas if you had it set up in a corporation, which I'll get into, and you're actively flipping, things could have been a lot different. So if you're flipping personally, the key takeaways I would say is, again, remember it's 100% taxable, and all of that income is going to get added onto your personal income and shoot you up a tax bracket or even into the higher tax bracket, depending on how much other income you have coming in.
That's a great point, because it makes a really key decision when you're going into that deal, because if you're unsure about whether or not you want to BRRRR the property or flip it, you're looking at two different types of financing moving forward. Obviously, if you're looking to, you've been doing predominantly flips in the past and you want to, save on those taxes, obviously getting that done in the numbered company could sound like it could be the way to move forward. But if for some reason you decide to pull the trigger and BRRRR the property midway through, it does, limit your options with financing. It is a little bit trickier on the A side, on the B side, to get properties done in a holding company. So I think, it really comes back to all the videos that we've done throughout the last year is, have that game plan and that plan in place ahead of time, and understand, if you're 80% in for a flip, you need to be aware that if for some reason you got a flip and you end up BRRRRing, you're going to be really limited with financing options. And then vice versa, if you're looking to BRRRR the property and then last minute you decide to flip, whether you've done that in a personal name or holding company, just being aware of what the outcomes could be and making sure that you have your strategy aligned with the outcomes that you want to the best of your ability.
Yeah, for sure, man. And I would just like to echo, you should always take a proactive approach and plan ahead rather than taking a reactive approach. And I'm sure both of us in our respective professions have seen people do that reactive approach, and suddenly they're getting hit with all kinds of fees, or you're in a position where you're going to have to pay a shitload of tax. Whereas if you just planned it out and came and gotten it structured the right way beforehand, we have a lot more options on how we can minimize this for you, right? So
I agree, man.
We have just
had a question. How do you switch to a flipping operating corp if you purchased under a holding corporation?
Yeah, so if you purchased your property under a holding corporation and it's already under that holding corporation, again, it's a little tougher. Like, it already has title registered to it, and your options are a little bit more limited. You could potentially allocate some of the income over into another corporation to reduce the amount taxed in the holding co. But what I would recommend overall is, if you can use a flipping corporation, and in that corporation you're going to be doing all your active flips, you're going to be showing traction going forward, then you'll be able to take advantage of the small business active income rate of 12.2% on the first $500,000 in income. So if you're an active flipper through a structured flipping corporation, on the first $500,000, you're going to be subject to 12.2% in taxes on 100% of income, which is a whole lot better than personal income. You're going to be paying 100%, and you hit that top tax bracket, you're paying 53 cents on the dollar in taxes on that same capital gain. So huge difference if you're going through a flipping corporation.
That's wild. That's a six-figure tip right there. You save people a lot of money, man.
I hope everyone's listening to this.
The other one thing I would say as well, if you're in a position where, for whatever reason, from a financing perspective, they have to close it in a holding company because that's the one with traction, that's the one with history, that's typically closed properties, and that's the one the lender feels more comfortable lending to versus the brand new flipping corporation. What you could do is, again, go ahead and close it in the holding company as required, and on the same day, make sure you already have a flipping corporation set up, and on the day of closing have a bare trust agreement executed between the holding company and the flipping company, saying that the flipping company is actually the true beneficial owner for tax purposes. And then that way your lender's happy because the property has been closed under the correct holding company. And for the CRA, it's the true beneficial owner is now the flipping company. And that's where you would show the active flipping income and take that 12.2% tax rate.
Yeah, I was actually, it's funny, I was kind of just thinking that because we've actually been talking about Bare Trust quite a bit with some of our clients, and that kind of came to my mind, and I wasn't sure if that would apply, so I'm actually really glad you answered that without me having to ask. And that's another great, one of those kind of tools in the belt that you can use is the Bare Trust, and I think that's something that a lot of investors should become much more familiar with than what they really are. And if you guys have questions, definitely reach out to Pirasaanth and get those questions in there, because it's a very interesting tool in the way that it's able to shift the liabilities from the property to the holding company. I mean, I'm not the expert and I don't want to talk too much on it and take that away from you, but from what we've learned and what we've been able to see and how we've been able to utilize that, it's quite an interesting product or quite an interesting tool to be able to utilize in the transaction.
For sure. Yeah, no, I actually ran the idea past a lawyer who he says he does some business, but he had honestly never heard of it before. Like he's heard of Bare Trust agreements, but never like utilizing it in a way like that. And he stopped for a second and he was like, "Man, that's really creative. Like that's pretty unreal. Like the difference between the mortgage broker you're working with, or the lawyer you're working with, or the CPA you're working with is literally going to save you 6 figures in your real estate investment journey as long as you just pick the right ones, guys. Stuff like this, high level stuff is what's going to put you in a situation to be able to scale. And Aaron and I are really trying to help our client base scale, whether that's buying a second one or buying your 10th one or getting a new multifamilies. Setting it up properly is so important, guys. We got a ton of questions coming in. One sec. All right.
I pull up my phone.
Banks don't like Bare Trust and they don't want to know about it. Any consequences tax side, even though the bank's lenders don't like it?
Yeah, so to answer that question, the best way I would look at it as, they're two separate groups of bodies who are interested in two separate things, right? The lender per se is interested in the property being closed and owned by the holding company that it was comfortable lending to, whereas the CRA at the end of the day only cares about getting their taxes. So as long as the Bare Trust agreement is done correctly and it's designating the beneficial owner of the property as that flipping co, and you report your taxes correctly and pay their 12.2 that they want, there's no issue there. The CRA and lender in this case have two different interests at mind, and as long as you satisfy both of those interests, there shouldn't be a problem.
Yeah, and that's something that we've noticed from the mortgage standpoint is there's a lot of very gray areas where you're not technically breaking the law, and for the record, nothing we do is illegal, but there's a lot of things where the mortgage industry, the mortgage industry is a very old industry, and it's the same with the insurance, and I'm sure it's very similar to you guys in the accounting industry as well too, where it's an old guy game, right? There's a lot of old things, and they're set in their ways, and they don't like, in 2021, people are pushing the boundaries of what they can do, and there's new things. We're starting to see it a lot with tiny homes and secondary dwellings on properties, and I have a client right now who's looking to purchase a property and has a secondary dwelling. The property itself is zoned legally for the zoning, and the city has the bylaws in place legally to have the secondary dwelling. And it's just a matter of telling the story and showing all the correct documentation and explaining it to the lender in a way where it's like, look, you guys aren't breaking your underwriting guidelines. We're not pushing anything outside the lines. Here's what it is, and just coming to terms with them. And one of the key things with working with industry partners is having people who are willing to push for the clients and be able to push the line and push the new standards. And that's something that we're always trying to do. There's always new things coming out, and we're always trying to push for those exceptions for our clients moving forward and helping them have new ways to get in and getting more creative.
Yeah, historically, the investor industry has been extremely underrepresented when it comes to financing and when it's come to taxes or any sort of guidance in a professional sense. And Aaron and I are obviously trying to bring that to light and be industry leaders where we're pushing towards, creating other products or helping people or banks understand how maybe wholesaling works. Like if the true value of something is something, like why not be able to lend on that thing, right? Like the handful of different things that we're trying to push in regards to opening up options for our borrowers. And obviously the banks are large financial institutions. It's going to take time to be able to do these things, but they understand the need and the want. And we shot a video with Matt last week, and we talked about this and how the paradigm shift from the old guard or the older generation transitioning all the wealth to the newer generation and our access to information and knowledge, the amount of purchases that are going to happen when that transfer of wealth comes is going to be astronomical. And we're trying to set our clients up to be in the best position possible to be able to execute on that.
Yeah, for sure, man. I think it's going to be crazy to see, and we got to all be, have our ducks in a row and be ready for it.
Mm-hmm.
And another thing I just wanted to add on to that point, Aaron, is again, how we said the lender has their own requirement. They're looking for a particular thing. The CRA is looking for a particular thing, which is getting their tax money. Well, another example, which I'm sure you guys run into a lot, is you have the borrower or the buyer who's going to be purchasing a property, and for whatever reason they have to close it in their name personally, but eventually they want to move it into a corporation afterwards. Now, in a situation like this, again, the CRA is perfectly happy if, there's something called a Section 85 rollover, which each corporation is allowed to do once in its lifetime. And essentially that allows you to move the asset from your personal name into the corporation tax-free without triggering a deemed disposition or a capital gain or anything like that, which is awesome. So from the CRA's perspective, you don't pay any taxes. It's great, right? However, the land registry says this is a change in ownership. We want you to pay land transfer tax. So it's just another example where, you did everything right. CRA is happy, but there's another body who has another requirement. And for them, it's a change in ownership. So they want land transfer tax, which sucks. But again, there's situations where it still makes sense. If you can put that property in there and, maybe do a portfolio loan, or you can use it to show more income to then qualify for another property, you guys can advise your clients accordingly. But there's instances where it still makes sense to do that.
Yeah, and I think this becomes a common theme through a lot of the things. It's just cost of opportunity. We talk about this all the time, especially on private lending. People see that immediate bill or the fees up front on the private, and they kind of shy away, realizing that they're going to be cash negative in the first year. But I think something that we talk about is like, what's your timeline? What are you looking at? Are you looking at just what you're going to make immediately on this first year? Or are you looking down the road 5, 10, 15 years when that building's been cash flowing for that long, and now your rents have gone up, your property value's gone up, that initial amount of money you to get in privately is now nothing compared to the equity that you've made and the cash flow that you've made over the years, and how many other properties have you been able to buy through refinancing and using the equity and the growth that you get that way. Same thing, if you're able to roll a building over and then the land transfer tax is the only thing that was standing in your way, talk to your professional, talk to the accountant, talk to us. Let's look what are the benefits and what are the cons. And if the benefits, greatly outweigh the cons, then the cost of opportunity on that, it makes sense to go ahead and move forward that transaction.
Yeah, 100%, man. And, I'll share something on my end. Like when me and my guys look at some of these bigger apartment building deals, we automatically always make at minimum a 5-year pro forma saying, okay, this is what the first year is going to look like. Boom. And usually, spoiler alert, it's always a negative number, sometimes a very big negative number, right? But then as long as we're forecasting right and year 2 is not as bad, year 3, year 4, and the year 5, we usually plan as that's the exit year, and you see a big juicy green check. And if that's how the pro forma looks, we're happy to make an offer and close that building. So it's all about, the future plan for it and what your exit's going to look like.
And sometimes that's what it is. Sometimes it's quite literally just like having a little bit of foresight and not looking for that instant check right away, and just being able to, take a look at 5 years down the road or 4 years down the road and take a look at what that's going to look like when you close in the property, when you make that big check at the end. Unfortunately, not all those big, large buildings and repurposing them is going to give you that cash right off the bat. You're going to have to do a little bit of work to get it, to get the big paycheck.
And I think it's a matter of one of those iceberg type memes, right? Where you get the cash flows on top and the cash flow is the peak, but no one talks about, the opportunity or the initial stages of being cash flow negative in the first couple of years, or the amount of money that potentially goes into it. And that's not talked about as much, and it doesn't become mainstream knowledge that getting into a property, you might be cash flow negative for the first year or the second year, or depending on the property, It might even be 3 years. But again, it comes down to, what are you looking to do? Are you looking to hold and create an asset that's going to cash flow for the next 20, 30 years and provide equity? Or are you looking at an immediate, in your immediate future? Because if that's the case, maybe it's a mindset shift, and we need to, just talk to the client and be able to refocus them and say, yeah, you know what, maybe in the first 2.5 years, you're going to be slightly cash flow negative, but look at the long-term growth and look what you're doing. And I think it just comes down to that. It's not everyone talks about it, so it's not as common knowledge, and people are really quick to walk away from those deals. Whereas it's, you need to realize what that walk away is and what that cost of opportunity is down the road.
Yeah, for sure, man. I think as investors, you'll quickly, especially as you become an experienced investor, you quickly learn the biggest and juiciest deals are the ones where you actually have to put that effort into it and turn the project around, per se. So when you buy it, it's typically going to be negative cash flow, and it's on you to, get the tenants turned over, get the units renovated, increase that net operating income, drive up that valuation of the building, refinance out afterwards, especially if you're using, private lender to initially get that deal done. Now you've stabilized the asset, cool. Now you refinance it, enjoy that cash flow. So those are the deals where you typically have the most upside. Anyways, it's just about getting that mindset shift and not being scared of the red numbers in year 1 and year 2.
Yeah, people aren't selling, $1 million buildings that are cash flowing crazy positive numbers. But there's a reason, these properties are either off market when they're really valued, or people aren't getting rid of their extremely profitable buildings, and if they are, they're at that point where they're looking to cash out, and now they're just going to go privately invest for the next 5 years. Like, it's, people hold on to those buildings after they get to that point because they're profitable, and I think it just, there's a reason why buildings are being sold and kept, right? And people just need to kind of, like you said, shift the mindset a little bit, understand why the deals are happening, and it's going to take a little bit of investing to get into. For
sure. I've yet to see a fully turnkey apartment building listed that wasn't a part of a big portfolio sell-off. And for whatever reason, if they were to sell it turnkey, that thing would be negative cash flow as hell, and there'd be no room for you to increase the operation, the net operating value. So what's the point anyways?
That's exactly. Yeah, that's it, man, for sure.
A ton of questions.
I think we did have a bunch of
come
questions
in here. Let me just take a look through here. One of them here was, let's take a look here. Oh, I can't find them all online. Let's take a look on here. What we got here? Okay, one of the questions here. There we go. Lost it. All right, this was from Al Hussein. It was, is it true that you would need multiple properties in order to have a corporation and use it to good use, or does it matter? So I think he's just wondering, do you need to have multiple properties in that corporation before it's effective, or can you start out with just an empty corporation and be able to use it effectively?
Yeah, for sure. Great question. That's honestly going to depend on a number of variables. What your personal income is, what your other income sources are coming in from a personal perspective, what you're actually going to be using the corporation for. So for example, if you're going to be using it for flipping, then I would recommend setting it up and putting the corporations into the flipping company right away, because there's an immediate benefit for you taking advantage of that active tax rate. Are you buying and holding? Then, there's suddenly a bunch more questions I got to ask, right? Like, you're buying and holding, what's your personal income looking like? Okay, so the first property you're bringing in, how much income is that going to be generating? What's the second one? What's the future goals looking like? Where do you see your portfolio in a few years from now? Because you don't want to go and set up the corporate 3-tiered structure and pay the initial incorporation fees as well as the compliance fees if the tax savings that you're going to get from that structure isn't going to justify itself, right? So usually, I need to know what the personal income is, as well as how much income you expect to come in from the properties. And from there, we can do that analysis to see if the tax savings make sense to implement the 3-tier structure. The other thing I would say on that is, if you're not going to go with the 3-tier structure route, for example, if you were to just buy and hold properties and put them into one corporation, you're going to be putting yourself subject to the passive investment tax rate, which is 50%.
For sure,
no bueno.
Clients all the time, like, I'm buying this one property, so I open up a Corp. I'm just like, well, like, in the long term, we're just gonna hold the one property. Like, it's gonna be worth it? Are you gonna pay to have the books done every year? Are you gonna all the upfront costs to be able to get it ready and set it up and all that stuff. Like, does it make sense for you financially to even do that? If you're going to own one property, you're not going to buy any more. It doesn't make any sense.
Right.
So asking those questions, or even having a quick conversation with yourself or somebody else, just, does this make sense? Like, easily, just yes or no. Like, a quick no is always good in our books. So.
Yeah.
I think that leads into another good question for investors who are experiencing, maybe don't know this, and new investors. What are some of the disadvantages of owning 1 to 4 unit residential investment properties, or even multi-unit investment properties in a corporation versus having them in your personal name? I think we talked about this a little bit beforehand, but just in terms of if you were to lose some rent for a year and you have a little bit of a loss on the year, what are some of the differences? How can you manage those, and what do you guys look for?
Yeah, for sure. So typically, if it's between 1 and 40 units, again, on the 40 unit side, you're generating a significant amount of income. So I would typically be more inclined to put that in a corporate structure. But so keeping properties personally, for example, the typical pros are that if there is a loss and it's in a loss position, you can net that loss against your other sources of income. So for example, your property, you just bought it in the first year, showing a $20,000 loss. You're making $100,000 in employment income. Your net taxable income is actually going to be $80,000. So you're going to save your personal tax rate on the $20,000. You can also apply your personal tax credits against your income if you hold the properties personally. So that's usually the two big benefits there. With the corporate side, though, there's a lot more benefits if things are structured the correct way. So if the property is in a loss position in the corporation, you're able to carry forward that loss for the next 20 years. So again, you bought that property in the first year, it showed a $20,000 loss. You're going to put that down in your books, file your tax return. Next year now, the corporation actually brings in, let's say, $40,000 in positive income. You've done an amazing job stabilizing the asset. Income is up significantly. You can take that capital loss that you had last year of $20,000, apply it towards this year, and now your net income, instead of being $40,000, is actually going to be $20,000, and you're going to pay taxes on that $20K. So you do have the ability to carry forward your losses. You can also carry it back up to 3 years as well to a previous profitable year if the corporation has other assets and was showing income previously related to other properties. Right? So that's some of the big advantages there. So often, let's say if you're in a position where I went through your personal income, I looked at the assets you're going to acquire, and it doesn't make sense for you to go the corporate route, because setting up the 3-tier structure and paying those fees is going to be more expensive than the tax savings you're going to get holding it personally, especially if the property is going to take a while to stabilize. That might be an area where I recommend keep it personally. You can take those losses, net it against your other income sources, and pay less taxes on the personal side. And then in the future, as you do buy more properties, and it makes sense for you to put it in the corp, set up the 3-tier structure, you can also have your corporate structure charge you personally management fees to shift some of that income into the corporate structure and then let it do its thing as well.
Yeah, so I actually wanted to touch base with you really quick on this, because I know you and I had a conversation about a week and a half ago. I had a client reach out, and a lot of you might find this a little bit interesting. So anybody who has an active corporation who wants to pay themselves nominally to keep under a certain tax bracket, if you hold the funds as retained earnings in your corporation, and you obviously pay your corporate tax at 12% if you're making under $500,000 in the corp, you can do something called an intracompany dividend, where you actually transfer the retained earnings into a holding corporation, and you can purchase real estate through that holding corporation. Guys, the power of this is, it can't be put into words. So you guys can quite literally purchase 5 units and up without having to qualify under your personal name. You can use those funds as a down payment source. You are quite literally not paying 50% tax on that money to be able to purchase property you don't need to qualify for.
Yeah, exactly. And that's one of the biggest tools in the 3-tier structure as well. So for those of you who don't know, picture a triangle like this. You have a holding company up here, a real estate company up here, property management company up here, or in the example Josh had just described, you have your active company here, holdco at the top. You can do intercompany dividends tax-free to an owning company without having to pay any taxes. So in this case, the active company is owned by the holding company. It is able to shoot up intercompany dividend into that company without paying taxes. And now your holding company can go ahead and purchase more real estate. In the 3-tier structure, what would happen is your holding company would inject funds right back into another corporation, and you can utilize that to purchase real estate as well. So very powerful. You don't have to pull the money out personally, pay a crazy amount of tax on the personal side, and then requalify for the property or inject that money back into a corp. You can simply move the funds using intercompany dividends.
Yeah, and your assets protected by your holding company as well, which is obviously the goal of all of it. So being able to use pre-tax in regards to you not having to take it out personally and pay tax on it, but paying corporate tax, being able to use money that was nominally taxed compared to what you would actually have to pay on it and make your money move for you guys. Like, you'd actually be able to purchase property without having to pay 50% of that tax and start making some serious moves. Obviously, 5 units and up, you're going to have to start looking at maybe alternative markets depending on how much capital you have available to you. But the power of that strategy is pretty crazy.
Yeah, for sure. And it's a great way, especially if you have an active business. As you're accumulating significant profits, you can utilize that to avoid having to pull the profits out personally and eat the personal taxes. Instead, keep it within your corporate structure and use it to invest. So, recently the realtors have been allowed to set up their own personal real estate corporations, so they can set up something called a PREC. And if you're a really good realtor, you're earning $300,000, $400,000 plus. You have all this money coming in. You only need about $80K, $100K for your own personal lifestyle. You draw that personally as a dividend. That remaining $200,000, $300,000, you could then have a holding company set up to own a holding company set up, have it set up another real estate company, intercompany the dividend, the funds into the real estate company, buy more real estate without pulling out those funds. Right.
And feeding off that as well too, we have some great business for sale programs as well too, where you don't technically need to use stated NOA income for these business for self guys. If you're a realtor and you claim self-employed income, we can use your 12 months bank statements from your commission earnings the year before. So, we can potentially take a look at your business income. If you're showing $200,000 in there, we could use, I think it's somewhere between like 70 to 90% of that income to qualify regardless of what you're showing on your NOA. So, that could be a really good setup in terms of being able to save money, pushing that money into your company, not having to show a whole lot of income, but still being able to use that gross revenue coming in and qualify for some products on the B side, especially now when B side rates are super competitive compared to where they were a couple of years ago, and even compared to where AAA rates were a couple of years ago. There's B side rates that are 2.54, 2.74 for owner occupied properties. So, in the grand scheme of things, not terrible rates. So there's a lot of, MacGyvering and maneuvering of structures and setups that can put you in a really pristine position to be able to move forward and save a lot of the tax.
Yeah, definitely. Exactly. And it's all about just putting the pieces on the table ahead of time, being proactive and making sure that you're setting things up in the right way.
100%. We have a ton of questions coming in right now.
I think they're just curious.
I think we're going to have to have some people just reach out to you at some point. But
for sure, guys, if you guys do have any questions, obviously reach out to Pirasaanth directly or reach out to us and we'll put you in touch either way, whatever works best for you guys. That being said, I think a chunk of the people on here right now did want to hear about our 20,000 down product, so we'll just touch a little bit on it. I know we touched about what you would need to qualify. Or you want to touch on the cost and how we go ahead verifying it?
Yeah, so obviously having the contractor quotes, they're going to want to see some sort of liquid asset to be able to cover that. So they're looking for cash, they're looking for credit cards, lines of credits, joint venture partners who are not coming untitled, promissory notes. They just want something secure, guys. It's something that you can show proof of that you're going to have that funds. It is a 6-month term. It is a fully open term, so there are no interest bonuses or interest penalties to get out of that mortgage early. There are discharge fees, as with every mortgage. So one thing to just kind of jump in there quick is even something that's fully open and doesn't have the interest penalties, there are discharge fees. So just keep that in mind. They're usually around $400 to $500, depending on which lender you're at. There is a fee built into the mortgage. Now this is something that just to kind of keep in mind, guys, is this fee, there is a bare minimum of a fee. So Calvert does charge, I think, at minimum $3,000 total. So if the loan amount is low enough, there is a $3,000 fee in there built in, but on average it is, I think, between 2 and 2.5% that's built in. paid out on the back end. What else am I missing here?
No, that's pretty much it. So what happens is if you guys are worried about exactly how much money you need to put out of your pocket into this thing, you need $20,000 down, and you have to be able to cover the $3,000 roughly for legal fees. The lender fee and the broker fee are tagged on the back end, registered on title, and then paid out when you sell your property. So this strategy is for people who are looking to get in and get out very quickly. No one's trying to sugarcoat the idea that it's not a very, very high interest rate. It's 15.5% annualized. It's 1.3% on your money per month. Obviously, some people are like, man, that's crazy expensive. Well, it's crazy expensive, but you're not putting 20% down on the property. If you have a $500,000 property, you no longer have $100,000 of dormant capital. You can do 2 flips. You can show us that if you have enough money, you can do 3 flips, 4 flips. We have clients who are doing multiple flips at a time and making more revenue. So this product isn't going to be for everybody. It's not going to work for everybody, but it is going to work for people who are looking to scale and who are looking and who really have their numbers dialed in, who understand what they're doing, who know what their ARV is, and who can execute on the strategy. We've seen a lot of success. One of our clients just made 6 figures in 2 months off of making a 6 flip. So this product is there. It's available. The fees are a lot cheaper than what a regular private would be. Completely open. No, there's no smoke and mirrors about what it's going to cost you. It's no cost to break other than the discharge fee. It's a phenomenal product. A lot of people are making decent money with it. If this is something you're interested in, obviously reach out to Aaron and myself.
They can close super quick, just to jump in. Like we closed the deal with them. I'll give you guys the story. The wholesaler brought us the deal late on a Thursday. We had a conversation with the clients on the Friday. They got the application ready, submitted, signed over the weekend. We got it in on Monday, and they closed Tuesday morning. So it was essentially a day and a half, 2 days to get the entire process done. They have a program set up with the FCT and title insurance where they can essentially just close with 1 lawyer, need be. So super quick that way. You're not dealing with 2 lawyers. And for those who are doing high volume flips too, if you guys have additional property with collateral in it, some free equity, they'll allow you guys to collateralize your property. They'll give you the loan for the down payment. They'll give you the loan for the renovation cost if there's enough equity, and they'll allow you to just draw off that equity, off that collateral charge, almost like a line of credit, depending on how much you guys have and how much you need. So keep that in mind as well too. These guys are super creative. They know who they're working with. They know their audience, and they're willing to help you guys out as long as there's something there to securitize the loan for them. They can get pretty creative. So
nice.
Yeah,
Interesting.
It's pretty great. Obviously, it's not specifically made for every single one. If your renovations are going to take a little longer than 6 months, probably not the product for you. But if you're looking to do something quick and efficiently, the application process, we'll just touch on it really quick. I know the football game started. We're slowly losing people here. But the application process, you have to qualify once for the entire calendar year, guys. We take a look at an application. We ask for your notice of assessments. You'll have a call with our partner. The partner will then verify, obviously, you have the viability to do it. Are you new? Have you done it before? We haven't had anybody get turned down yet. So, I mean, if you have the availability and capital to be able to execute, you know what you're doing, most of the time you're going to be able to get approved. We do need a notice of assessment just to see you don't owe any money to the government. It's really important you don't owe any HST. It's a super priority tax, if anybody didn't know, so the government can go after your assets, and then it subordinates our lender's position, so you can't owe any tax to the government. Other than that, great product, guys. If you have any questions, feel free to reach out. We had a great chat with Pirasaanth. If you guys do have any questions for him, reach out to him. He's always available, and
we'll make sure his contact info is posted one way or another with this video when we post it up, so you guys will have access to the contact information.
For sure.
Yeah, man.
Awesome, gents.
Any comments?
On my end, honestly, it was great chatting with you. The one thing I would say take away is, again, do that pre-planning. Take a proactive approach rather than a reactive approach, and it'll save you a lot of time and a lot of headaches.
100%. I agree.
All right, guys. Well, thanks so much, everybody. Go enjoy the Super Bowl. We appreciate all of your time. Next week, we'll be back talking about one of our videos that dropped last week and possibly might have another special guest. If you have any questions, drop them in the comment below. If you are on YouTube, please hit the subscribe button and like our stuff. It helps with the algorithm, and it's going to allow us to make more content for you. Awesome. All right, guys. Take care.
All right, guys. Take
All
care.
right. See you, man.
Bye.